students are there in the class? Mr. Satish. Seems to be silent and no student. Hmm. Forex markets, financial instruments. Is it being recorded or not?
Contracts are very important. All types of contracts with illustrations and the differentiations between each one, you can focus. Very important. Problems of conversion from one to another. Speculations with currencies and future currencies, inter and intra. And problems based on this intra and intercurrencies, wherein two different countries with the same maturity are quoted in two different, rates. The speculators usually happens to perform these services where they will reverse both the contracts before maturity, and the loss or profit is been expected. Whatever is expected will be relatively shown and the in the other currencies of the futures. Simple yet short yet a very important content, conceptual knowledge in this unit, which consists of currency futures, hedging, what is the ratio of hedging, cross hedging, what is it, delta. Then we have contracts, differences between contracts, and a very simple conversion from one contract to another contract, differentiation, and simple problems based on the contracts can be focused on besides intra and intercurrency spread also. This unit is consisting of currency options, which basically talks all about the globalized and liberalized economy, wherein the currency derivatives, options in the Indian stock market would prove an opportunity to take a view on exchange and the rate, and also to fulfill the investments of hedging currencies, forwarding futures. All these are very important instruments which fluctuates the exchange rates. So in view of this, you look at the currency options, you will find the various characteristics or features which project the currency options. Types are there, terminologies which are being most commonly used, gains or losses, determinants, and then hedging with currency, speculations with how speculations can be done with the currency options. Look at characteristics. It is very highly flexible. Down payment is available. Settlement is quite easy, and there are no money, no economical or share is being used. So the option is not used here till maturity. The agreements automatically lapses if there is no settlement. Settlement is not required. Generally, it lapses with the lapse in the maturity. Non-linearity, profits or losses are quite not symmetrical and in an open option market. Underlying assets is a derivatives security. The uses and the popularity of this option has been expanding rapidly, and this will take the underlying assets for which it is today. call option, put option, expiration date, strike price, parties to option contracts. All these are the very significant features of the currency options. And then look at the types of options that are available, nature of exercise, nature of markets, kind of markets that are available, underlying assets. Okay. And the terminology, the most commonly used terms are call options, put options. One has to be thorough in this in order to better understand and also execute certain problems on this. If you are perfect in this, or if you go sometimes miss this or go wrong with this, then you may probably end up getting an wrong understanding of the subject. So it is quite important for everyone. Those who are doing with this subject needs to equip themselves with certain few basics terminology of options, and those includes call option, put option, European style, American style, strike price, or we call exercise price also alternatively. Expiration date, maturity date, strike date are all same. At the money, in the money, out of the money. In the money, call option is wherein spot rate is greater than the strike rate, and put option is wherein the strike rate is less than the spot rate. At the money is spot rate is equals to strike rate always. Also put option may strike rate is equals to spot rate. Out of the money is wherein the spot rate is less than the strike rate, and in put option it is considered as strike rate is greater than the spot rate. Intrinsic value. Intrinsic value is a value which is a value or amount in which an option is put in the money. For call options, this is difference between underlying stock prices and the strike prices. Besides time value, it represents the time and the value as on that time, as the spot rate of the underlying currency here is expected to move towards the money position between signing of the contract and the maturity date. Long term and short term refers to the period where the writer of an option prefers operating transaction, closing transaction, option premium, option holder, option writer, assigned writer. Gains or losses of the option traders. Yeah. As you can all understand, gains and losses are all parts of the options, and the gains happens when the spot rate is more, and if you look at the calculation, the spot rate minus the strike price minus the premium, you'll arrive at the call option buyer's gain. And similarly, if it is reverse, it is call option payout, that is loss. Put option buyers is when the striker's exercise, that is exercise rate is minus spot rate minus premium. A simple problems wherein you are given about all the details on strike rate, spot rate, and the premium. You are supposed to calculate the buyer's gain or loss. In this unit, you can focus on determinants of options pricing, determinants of option pricing, very important. This will give you an understanding of what all are the challenges in option pricing and how each one of them plays a significant role. You will be gaining here. Okay. And then hedging with currency options. Hedging with currency options, through purchase options, through selling options. Okay. And based on this purchase and sale option together. So there are three combination: purchase and sale together. So again, you have a simple small illustration where you are given, goods, and then all these denominations are in USD. So you have to be very careful. Strike prices, premium prices are given. You are asked to calculate compensation of loss or gain. So spot rate will be given by using the formulas. We just discussed formulas can be applied, where your spot rate minus the strike rate minus the premium, you will get the loss or profit, gain or profit. Any movement in the currencies are being observed by the speculators, and they provide opportunities into transactions. So these currency options, both call and put, can be used in order to speculate the currencies market. So speculation is with the help of call options, speculation with the help of put options, and the speculations with the help of both call and put options you have. And when it comes to combinations of options, turned, spread, vertical, all these are various options and their combinations are given in the form of a table. You can go through. There is in vertical spread option, horizontal. In vertical, if you look at the buying and selling option, for the same expiry month and different strike prices are given. Whereas in horizontal, call options with same strike price but different expiry dates. So long strangles, short strangles, long butterfly, short butterflies. All these are the various types and combinations of options. Look at the question, long answers. All these short answers are the conceptual knowledge based. American option, straddle, European option, and writer of the option, holder of the options. So all these are, in order to develop your conceptual knowledge and strengthen your IFM, subject. It is very important. Very short and simple. You all can, easily concentrate on. Look at the long answers type and the important, um, you know, concepts to be focused on is the speculators, importers and exporters, straddle and strangle. What is it actually basically? Again, it is a conceptual knowledge, okay? Likewise is determinants, characteristics of option. All these, will give you an understanding of the fundamentals of international financial markets. And we have blocks 3, wherein foreign exchange exposure management is covered, in which 3 units are there, wherein forecasting, measurement, management of foreign exchange exposure is discussed. If you look at forecasting exchange rates, this includes need for exchange, why exchange rate forward is required, problems which are faced, techniques of forecasting error, controlled exchange rate. All these are discussed in the unit 7. Look at the need of forecasting, relevance and relevance approaches. There are 2 methodology in order to understand the foreign exchange forecasting. That is irrelevance theory and relevance approach theory. A methodology in order to better understand the subject. Forecasting, forecast irrelevance approach is wherein a market with a weak efficiency and historical exchange rates contain minimum information which is used for forecasting the exchange rate. Here again, the efficiency is strong. Public, not just public, but also private information is put on, can be, told about future spots, ruling out the need for forecasting. Whereas a relevance approach focuses on efficiency, and this is, found in the foreign exchange markets. Basically, for forecasting of exchange rate is highly significant in various reasons, and more in case of multinational MNCs. So the reasons why it is so is because of hedging decisions, investments of short-term funds, long-term investments, and financing decisions, assessment of your earnings. All these, if you look at every earnings of subsidiaries are normally reported in the parent company of financial statements. Different countries have different, operating systems, and they are all consolidated together. All this is done with the view in order to just ensure that international operations are all in line, aligned together from different sources, and put it in a currency which is quite essential to be presented. And likewise, there are quite challenges and problems which are faced in exchange rate forecasting because of multinational companies working across the globe. There are, quite challenges. Suppose if a country is consistently facing high rate of inflation, then the real rate of exchange drastically changes, and the forecast will have a nominal exchange rate. Likewise, it might not help in making a right decision. So there are reasons not so useful for evaluating the total risk on the whole. Techniques of forecasting, if you look at, there are technical forecasting, fundamentals, market-based forecasting, mixed forecasting techniques. All these are various methodologies in order to do the forecasting. And problems based on all this forecasting, where you can measure the forecasting in terms of numbers. Then measurement of foreign exchange exposure. Under this, types of foreign exchange exposure, transaction exposure, real operating exposure, and translation exposure is been covered. Look at the types of exchange rate exposure. It consists of two: translation of or accounting exposure, and economic. Under economic, transactions and real operating. Export and import on open account. Transaction exposure, rupee worth of accounts receivable when actual settlement is made, minus rupee worth of accounts receivable when trade transactions is being initiated, is subtracted in order to get the transaction exposure, which can be either gain or a loss. Borrowing and lending in a foreign company. Intra-firm flow in an international company, consolidated net exposures. Okay, the transaction exposure on account of trade is divided into quotation, backlog, billing. Okay, the first one is when the exporter quotes a price in a foreign currency, a importer places places that price in terms and in quotation exposure in the first part. The second part, it is backlog exposure, and it is existing between placements and placement of order and importer, and the shipping and billing by the seller. Billing exposure is wherein it exists between billing of the shipment and the settlement of trade payments. You can see how a transaction exposure of a US parent company is given: Canada, Germany, Switzerland, and net exposure. In outflows, net flows, pre-exchange, post-exchange, pre-exchange values, post-exchange value, and the size of exposure. All these are million units on of different currencies. Then comes a real operating exposure. This is the manifesting changes of inflation adjusted future cash flows. The real operating exposure arises when changes in exchange rates together with rates of inflation modified the amount and risk of element of a country's futures, revenue and cost streams. The measurement of real operating cash flow is not an easy, because measurement inflation rate differential is quite challenging, and the same becomes even more difficult when the countries are experiencing highly value rate of inflation. While measuring the real operating exposure, we have to understand the impact of inflation and the exchange on the foreign cash flows. But it so happens that the inflation differential in India also goes up by any number, and the real operating exposure will become zero. Impact on inflation and on revenue, impact of inflation on cost. Okay, all these are various impacts on currencies, cash flows, real operating expenses, etc. Then translation exposure, and there are various here. Translation exposure is at times argued that it is irrelevant because it does not influence the cash flow. Neither it does influence the cash flow nor it subsidiaries earnings. But since the change in the value of the currency of the host country, it has an impact on the net worth, we have to consider the measurement of accounting exposure, and it is said to be highly irrelevant. Yet, this is also known as accounting exposure, and it emerges out of account of consolidation of financial statement of different MNCs. Looking at the size of accounting exposure, it all depends on, no doubt, the changes in the value, but it also depends upon the extent of involvement of the subsidiaries. The larger the involvement of the subsidiary in the parents, the greater will be the exposure. That's how it is understood and explained. Similarly, as a method vary, which in their approach, it is natural that different methods would yield, of course, different results. Yet, we do have certain methods of translation, and those are like current rate method, non-current rate method, non-monetary method, and temporal method. All these methods are adopted in order to calculate the translational exchange rate based on current rate, historical rate, average rate. Okay. Yes. This is all about the foreign exchange exposure. Focus on learning the meaning, distinguishing feature about accounting and economic exposure, transaction exposure, real operating emergency of exposures, consolidated, all these types of exposures. Focus on learning how different methods of translation arrive at different size of translation exposure in different methods of translations, how they differ. All right. So with this, we conclude this session and we continue to meet you again in the next week, upcoming week. Hope you put up good strength and respond to the questions and also to the messages that are put up. But on the other side, not able to get any. But anyways, the session must go on, and so is. See you all in the next week class. Thank you.
Okay, madam. Thank you.